From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
This is Balance of Power on Bloomberg TV and radio. Alongside Joe Matthew, I'm Kayleigh Lyons in Washington, coming to you with some breaking news tonight. Moody's just announcing it's downgrading the U.S. to a AA1 credit rating from AAA, citing what we've been seeing play out between Congress and the White House. It is about, Joe, the fiscal health of the United States. Yep. Moody's noting successive U.S. administrations and Congress failing to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs, going on to say they do not believe that material multi-year reductions in mandatory spending and deficits will result from the current fiscal proposals under consideration.
Yeah, pretty remarkable. Just hours after the Budget Committee failed to clear the one big beautiful bill that President Trump speaks about so often. Kayleigh, it of course would extend or make permanent the Trump tax cuts. Paying for them has been a major question, however, with many analysts suggesting that it would add as much as $3 and possibly $5 trillion to the debt and deficit. This is why we saw members of the Freedom Caucus voting against that bill today. And
it certainly gives fuel to the arguments they will be making as negotiations continue this weekend. And we should all keep in mind here, Moody's was the last one standing with the highest credit rating on the U.S. Fitch had already downgraded in August 2023 after the debt ceiling fight. S&P, of course, in the debt ceiling fight in 2011. So that is the context with which we turn to Bloomberg's international economics and policy editor, Michael McKee, as well as Bloomberg's Romaine Bostick, joining us from New York. Romaine, just to begin with you, obviously, while the kind of reasoning here might be unexpected, timing certainly is a bit of a surprise. What impact should we expect this to have across asset classes?
Well, I mean, of course, my first thought, Kayleigh, was going back to 2011, when we talk about this idea of the S&P when they made that big downgrade here and the severe market reaction that we saw. Right now, we should point out, of course, most of the markets were closed. You still have futures trading. You did see a big leg down in Treasury futures as well as in the TLT, which primarily tracks longer dated Treasury prices. You're also seeing equity markets, at least as reflected through some of the ETFs that are still trading, like the triple Qs, which tracks the NASDAQ 100, as well as the SPY, also moving slightly lower. Now, the declines are fractional, to be sure. We're talking about 3, 4, 5/10%. But again, it is late on a Friday, so we could maybe see much more of a reaction when we come back on Monday morning. But this, of course, gets to this idea of something that the market has been pushing back on. And you know this, Kayleigh, you know this, Joe. A bond market has been very concerned here about rising deficit levels, about rising debt servicing cost levels. And with this bill that was working its way through Congress, it was very clear here that there was going to be potentially some pushback from the market. I was a little surprised that we got the pushback, though, at least at this stage, from one of the ratings companies.
Isn't that right? Insights from Michael McKee. Michael, this comes more than a year after Moody's changed its outlook on the U.S. to negative. What's happened in that period of time to lead to the actual downgrade?
Well, I suppose I could shorthand that by saying nothing, Joe. Moody's and the other credit rating agencies have been concerned about the U.S. debt profile and how it continues to grow. And there have been suggestions that this could be coming for quite some time. It is a little unusual in terms of timing, but the forcing issue may be the big, beautiful bill, and Moody's looking at that. They say in their statement that they don't think it's going to do anything to lower the U.S. debt situation. So they felt like they could go ahead and cut us one notch. Now, it means the U.S. has been downgraded, as Kayleigh said, by all three agencies. That puts us below a number. There are 10 countries now left that have AAA ratings. The U.S. is no longer a AAA rated country, even though it is the largest country, largest economy in the world.
Well, so when we consider, Mike, as I sit here on Balance of Power, thinking about the response we might see from an administration, which has argued, at least if you listen to the Treasury Secretary repeatedly suggesting it's not actually the deficit level that matters. It's all about debt to GDP. And even that isn't that bad. Mike, is this Moody's essentially saying that that argument does not hold water, especially in the current interest rate environment we're in when we're talking about the interest burden?
Absolutely. Moody's is looking at projections that the U.S. Debt to GDP ratio is going to rise to well over 100% over the next couple of years, maybe as high as 140, 150% on the path that we are on. And they say that just suggests a sort of level of fiscal irresponsibility that justifies the downgrade. The question now is, how does that impact the U.S. itself? Because it will likely raise interest costs, which will increase the debt, because the government's going to have to pay more for its borrowing. As Romaine said, the markets are largely closed. We'll see when we get to Sunday night, Monday morning, what this means. It doesn't likely mean forced selling. After the S&P downgrade in 2011, a lot of bond contracts were changed. They took out the reference to the AAA rating, and they put in just U.S. government debt. And because of the size of the Treasury market, that's generally been considered acceptable reference to the debt. And it means that just because there's a downgrade doesn't mean a lot of people have to sell. But it certainly probably means higher interest rates.
All right, Mike, thank you so much. Bloomberg's Mike McKee and The Close co-anchor Romaine Bostick with instant reaction to this important headline. And for more on the downgrade and the economic implications, we turn to SMBC Nikko Securities chief U.S. economist Joe Lavorgna, of course, a veteran of the first Trump administration. Joe, it's great to have you back. Your insights here, was this deserved, or are you going to tell me Moody's is making a political move?
No, I don't think it was deserved. Well, I mean, actually, I didn't want to say that, but you said it, and the timing is just very strange. Look, the bill is working itself through the Congress. We have to see what it looks like. The CBO's estimates of how they score, I have real problems with. For example, they're assuming GDP at less than 2%. I don't know what Moody's is assuming. But when you have 100% debt to GDP, as Secretary Bessent has mentioned, that is not unusual in the world we're in, especially coming after a period of very low rates. You had negative rates and zero rates for much of the industrialized world. So here you are, you're downgrading the country that has the reserve currency. You're downgrading the country that's growing the fastest of any industrialized countries. And you're also downgrading the country that has the best productivity per capita of any country. So to do this, I'm completely nonplussed by it. It doesn't make any sense. And to do it on a Friday before even seeing a bill, which I think will actually potentially, I'm an optimist, do some good stuff on the spending and certainly raise revenues. I mean, I just don't understand how, and I'm guessing this is behind Moody's analysis. I don't know because I've not seen it yet. But I mean, when you assume that an expiring of a tax package that's been in place for 7.5 years is somehow going to add to the deficit, that just doesn't that's fundamentally wrong, in my opinion. It's just very poor forecasting. So you have a big problem with what Moody's did.
Well, I'll give you some of Moody's reasoning, Joe, and I'm reading here directly from the statement. They say over the next decade, we expect larger deficits as entitlement spending rises while government revenue remains broadly flat. They say, in turn, that leads to large fiscal deficits, driving the debt and interest burden higher. What part of that thinking do they have wrong here? Is it the revenue side or entitlement spending going up? Because is that not the trajectory?
No, the trajectory, well, if you look at the CBO scoring, it's actually beyond the next 10 years where Medicaid are driving it. It's actually more so than Social Security. But that's way far out. I mean, the revenue share of GDP has been above its historical average. We've recently had a really excessive spending. And we have to see actually what that spending looks like. We're working with the Congress. Congress is working rather to pass a budget. So we don't know what the spending is going to look like. I mean, we knew this was going to happen, Kayleigh. The long-term trends by some estimates look poor. This isn't new news. So why would you do it now without even knowing what the budget looks like? And by the way, 10-year yields were recently under 4%, and they've risen up into the 445, 450 range because we've taken recession risk off and the U.S. economy looks healthy. So I don't know. And term premium, by the way, which is higher, is still lower than where it was in January. So again, without going into all the details that Moody's came up with, their assumptions to me, I don't agree with. I don't agree with them.
Well, it's really interesting here when they point to $4 trillion being added to the federal deficit over the next decade. Joe, are you taking issue with the reasoning or the timing here? Because Moody's hasn't seen the bill yet.
No, the reasoning. So I'm assuming they're using CBO analysis. So, for example, CBO assumes 1.8% growth the next 10 years. That is ridiculously low. It's a point or more less than what Trump had during his first 3 years. It's even a lot weaker than where President Biden was the last few years. The difference between 1.8% growth and 2.4, 2.5, I think we could be at 3, but whatever, if it's mid twos, the revenue difference on that alone is worth $2 trillion. If it's a 3% economy, which I think we can get back to, that's $4 trillion of differential revenues between what CBO is forecasting and what we would get based on just the growth. And that's keeping the revenue shares the same. So I have a real problem with those assumptions. They're economically doom and gloom, and I don't agree with it.
Well, when we consider, though, the wider economic context with which Moody's is doing this, yes, there are negotiations happening on Capitol Hill, Joe, but there's also negotiations happening with a number of countries trying to set new rates of tariffs that, according to the administration, are going to be at least 10% as a baseline. It's going to be very hard to get below that. And that brings us to the highest level we have seen in decades. Does that not have some bearing when we consider the fiscal health of the United States as well, the potential inflationary or growth impacts that could have?
You were doing, I was almost with you all the way, Kayleigh, on that. You're certainly on the revenue side. I mean, we're on track to run $200 billion of tariff revenue this year at the current run rate. That's a lot of money. It has yet to show up at all in the inflation data. Amazingly, the inflation data have undershot expectations. The problem is when CBO does its analysis, because it assumes it's part of law, it's got to be legislated, those tariff numbers aren't even a part of it. So let's say it's only $100 billion. Let's say it's the bottom end, and that's super pessimistic. That over 10 years, that's another $1 trillion. I have to believe that when the budget comes out, there's going to be some slowdown in spending where you could save $1 trillion over a 10-year period. Because remember, it's $100 billion times 10 gives you the trillion. So the tariff revenues aren't even going to be part of this scoring, and they should, given how much revenues we're already raising.
Does this not strengthen the hand of members of the Freedom Caucus, though, who have expressed concern about rising debt and deficits? They just got an interesting bit of company in this argument, Joe.
Well, certainly the fiscal hawks will use this as a reason to be more careful on the outlook. And as it relates to the spending, I'm all for it. Yes, we need to slow the pace of spending. By the way, when we talk about spending cuts, Mike, as you know, these are never cuts. They're only cuts relative
I'm just another
to
Joe. It's just us two Joes talking here.
If we go from 6% nominal spending, let's say, to 5%, that's a 1% spending cut. So I certainly think we desperately need to slow the pace of spending. But again, because a lot of those deficit projections long term are on the revenue side, they're assuming way too pessimistic growth. They're assuming that if we have massive tax increases next year, the largest ever, that's going to raise revenue. It won't work that way. But certainly on the spending side, there's room to cut, no question, or slow the spending anyway.
Well, Joe, when we consider that part of what Moody's here is talking about is the interest burden, I do wonder if you expect, given what we've already heard from President Trump about how he feels about where current interest rates are, if you would expect, knowing the president as you do, having worked in his administration, for him to be pushing for the actual rate set by the Federal Reserve to be lower, also in the name of the long-term fiscal health of the United States. Would you be surprised if he steps in with that argument?
Maybe, but here's what I want to say, though. If you look at the curve, the yield curve, as you know, is still very flat. And recently, the two-year note was above the Fed funds rate. So you have a situation where the curve is flat, so the interest costs are significantly high. If we have lower rates and the curve normalizes and the funds rate is around 250 to 275, which is where I think neutral is, those interest costs are all of a sudden going to look a lot lower. And by Jay Powell's own inflation metric, his supercore, which is the services economy, excluding energy and housing, it's 50% of inflation, has no impact or not any impact. Tariffs have no impact on that. That right now suggests monetary policy is as tight as it's been before the Fed started cutting rates. So there's a very powerful argument right now based on real rates that the Fed could and should be cutting. And as that curve normalizes and those short rates fall, the interest cost is going to come down a lot. I doubt that that's in Moody's estimates either.
Joe, thanks for being with us here moments after this news broke. Joe Lavorgna,
Thank you.
Economist, SMBC, Nikko, Securities. Up next, we have a lot more on this breaking news about the U.S. ratings downgrade. We'll be live on Capitol Hill for reaction as well. This is Balance of Power on Bloomberg TV and radio.
Welcome back to Balance of Power on Bloomberg TV and radio. As we come to you live in Washington with breaking news, Moody's downgrading the U.S.'s credit rating to AA1 from AAA, citing specifically in part their belief that there will not be multi-year reductions in mandatory spending and deficits resulting from current fiscal policy proposals under consideration, putting a spotlight on Capitol Hill, which is where we go next, as we consider the fact that the House Budget Committee, after conservative revolt over the fiscal trajectory of the United States that could be changed by this bill, shot down, of course, its advancement, the tax package, through the Budget Committee. We want to get more now with Jack Fitzpatrick of Bloomberg Government. Jack, we know conversations around this are going to continue with these conservative members this weekend. How much fuel does this downgrade give to their arguments when we consider those fiscal hawks?
It adds a lot of fuel. On one hand, you had 4 conservative holdouts just in the Budget Committee alone. So this was a major statement that they're serious about holding up a bill unless it's more fiscally conservative. On the other hand, I'd point out the SALT Republicans, who want a more generous tax deduction for their constituents, have also threatened to hold up this bill. So there is the risk that if you give more in Medicaid spending reductions and more fiscally conservative measures to the conservatives, some of that may ultimately just be redirected to a more generous SALT deduction. So there's not necessarily a fair takeaway today that this will be a far more conservative bill, even as a few conservatives really put their foot down and demanded some additional concessions.
Jack, we understand there's a 10 p.m. hearing set for Sunday, a Sunday night hearing, the Budget Committee, to try to do this all over again. You can let us know if that's still the case, but I'm wondering about the Republican no's, Roy, Norman, Clyde, Burchett. What changes between now and then for these Freedom Caucus members who don't like anything they're seeing?
Roy and Norman want an earlier phase-in of the Medicaid cuts, whether you want to call them cuts or spending reductions. They want it to be a more aggressive path. Burchett wants an earlier attempt to pull back the clean energy tax credits. Clyde brought up Medicaid and also essentially wants less taxes on gun sales. You can come up with some combination of offer. You need at least 2 of them to get on board in the Budget Committee, but you also need either Roy or Norman specifically to get on board to get it through the Rules Committee, because they're both on there and you can only lose 2 votes. So they need some significant combination, potentially 3 out of the 4 functionally, to get this thing to the House floor sometime next week.
Well, it's going to have to be a productive weekend for that to happen. Bloomberg's Jack Fitzpatrick from his perch on Capitol Hill. Jack, thank you for the reporting. As we now add the voice, Democratic Congressman Raja Krishnamoorthi of Illinois. Congressman, it's great to have you with us here. Quite the afternoon and evening we've found ourselves in here in Washington, having seen that bill fail in the Budget Committee, and only hours later, this credit downgrade that we just received from Moody's. Is Moody's telling us something that other lawmakers ought to be listening to, Congressman? What are we learning about the fiscal health of our nation?
Well, it's precarious. And this particular bill, they call it the big, beautiful bill. I think it's a large, lousy law, would basically put trillions of dollars on America's credit card, basically piling up debt for future generations. And I think that Moody's recognizes that and is sending a signal to them not to pass this bill.
And yet they are going to continue to try over the weekend, Congressman. Obviously, there's many questions about this timeline, knowing as well that embedded in this bill is a lift to the debt ceiling. And it's the debt ceiling that has in part caused the downgraded ratings we've already seen from the other credit agencies. Fitch and S&P already have warned about this. Do you think that there may be a possibility Democrats, in the name of the full faith and credit of the United States, are going to have to step in at some point to work with Republicans to make sure the debt ceiling gets raised in a timely manner?
Possibly, but only if the Republicans don't shred the social safety net in the name of funding tax cuts for the wealthiest among us. Remember, this same bill basically takes Medicaid away from upwards of 10 million Americans, their sole source of health care, and basically leaves them more destitute, sicker, and unable to work, making them more reliant on the social safety net. I'm a product myself of public housing and food stamps, and I would not be here but for the fact that the government stepped in the breach when my parents fell down economically. And yet we're here talking about doing the same to millions of other people. Democrats are not going to stand for that. They're not going to support that type of approach to our budget the way that the Republicans are right now.
Well, Congressman, considering the fact that Democrats do not have a seat at the table for this debate in the reconciliation process by design, are you quietly hoping the Freedom Caucus derails this whole thing?
I think whether I do or not, I think that's what they're doing right now. And you see the infighting. I think particularly it's because constituents are kind of raising the alarm. Democrats are kind of shining a light on the harm that's being done by these proposed cuts. I'm getting calls constantly, Joe, from people who are basically fearful that not only is Medicaid going to be cut, but their Social Security and Medicare are also going to be affected. And so I got to believe that lawmakers on the other side are getting the same types of calls. And so they're left with a choice. Do they choose their constituents or do they choose Donald Trump? And if they choose the latter, they're going to be held accountable.
Well, Congressman, you, of course, right now are in the middle of an active run for a Senate seat being vacated by Dick Durbin. And I do wonder what you expect from the United States Senate, the chamber you hope to join here, as there are senators who have made similar suggestions to you, even on the Republican side, about concerns over Medicaid, over the kind of spending cuts we are looking at here. Are you counting on the Senate to send the House back a very different bill, assuming, of course, that the House can pass one in the first place?
I think they will. I think that they're not going to, based on what I've heard, it's very possible that they're not going to go along with these types of cuts. And I think at the end of the day, basically, Donald Trump is trying to fund these tax cuts on the back of working families and the poor. And that's just something that doesn't go over well. And not only is Moody's, by the way, this is the first time that all three ratings agencies have downgraded America's debt at the same time. But not only is this bill horrible from a fiscal standpoint, but it's morally wrong. And I think that's something that a lot of people is weighing on a lot of people as well.
When you hear about a budget committee hearing at 10 p.m. on a Sunday, Congressman, does that tell you that the chairman thinks he has the votes or not?
It signals to me that perhaps he's hoping that some members don't show up. I think that it's a desperate attempt to try to rescue that particular bill. But regardless of what happens on Sunday night, I guarantee you that constituents are going to be paying attention, not only Sunday night, but the next week as well.
Of course, this weekend in Washington is going to be a very busy one for that reason. And that's what President Trump is returning to as he makes his journey back to Washington from his trip in the Middle East. I do want to ask you, given you're the ranking member on the China Select Committee in the House, about the deals President Trump struck while there, specifically the moves the U.S. is making when it comes to chips and technology that Saudi Arabia and the UAE are going to have access to. Are you worried about the end market for those ultimately ending up being China, not these countries?
Yes, I think it's a horrible deal. I think that, first of all, rescission of or ending of the what's called the AI diffusion rule. Essentially, basically, this rule prevents us from selling to individuals or entities in countries that might end up sharing that technology with the Chinese Communist Party. And that's what's going to happen here. Okay, let's be very clear. If we allow American chip companies to sell the highest end semiconductors to companies like G42 in the United Arab Emirates, that technology is going to end up in the hands of the Chinese government, and it's going to be used against us. It's going to be used in their military systems, and it's going to be used to perpetrate human rights abuses, such as in the Uyghur genocide.
Something tells me that the China Select Committee, however, will not be holding a hearing on that, Congressman. Is it something, as ranking member, that you'll push for?
I'm going to be pushing to shine a light on this as much as I possibly can, because it's one of those issues where I think that these export controls really have made a difference, a critical difference. We have to keep the CCP away from these highest end semiconductor chips. They will use those chips against us militarily, whether it's in hypersonic missiles or in other weapon systems, and they will use it to perfect their surveillance state, their techno-authoritarian surveillance state against Uyghurs, Tibetans, and others.
Let's keep this conversation going, Congressman. It's good to have you back. Roger Krishnamoorthi of Illinois, we thank you, as always, for the insights here on Bloomberg TV and radio. If you can believe it, we actually have more breaking news to talk about this evening, and this time it's coming from the Supreme Court, handing down a defeat to the president a short time ago, temporarily blocking his use of a wartime law to justify the quick deportation of hundreds of Venezuelan migrants, saying the administration did not provide sufficient notice for doing so. For more, we're glad to be joined by Bloomberg's Sara Forden. Sara, it's great to have you with us. Can you put in perspective how much impact this ruling would have?
Well, this ruling is all about due process. So the Supreme Court is saying that the government cannot just deport these people who are in detention facilities across the country without giving them due notice, which means more than 24 hours, and also the ability to notify their lawyers and file an appeal. So they're saying these people need to be able to file habeas petitions to protest their deportation, to seek their release. And this is really an extension of the earlier order that we saw come in April 19th, in 1 o'clock in the morning when they were acting under extreme urgency because they had reports that these men were being put on buses and taken to airports.
We have gotten reaction from President Trump to this ruling, perhaps no surprise. All caps on Truth Social. The Supreme Court won't allow us to get criminals out of our country. But, Sara, my understanding of what you just said is not that the Supreme Court is saying you can't get them out. You just have to go through due process in order to do so. This isn't necessarily, for example, saying the administration firmly cannot use the Aliens Enemies Act under any circumstances. You just need due process along with that.
This is exactly right. They have not weighed in at all on the use of the Alien Enemies Act. This is about due process. But they're also pointing to another case, which is the Abrego-Garcia case, in which we had a hearing again today. And the other issue is that the government has not provided any evidence about any of these detainees to show that they are criminals. So we just have the government's word, but there's a lot of back and forth between judges and the administration over whether or not these people can be detained and deported and why. So, for example, in the Abrego-Garcia case, the judge today was very frustrated because the government has not answered any questions about this man and why he was deported. And the government has already admitted that he was mistakenly deported. And they're invoking the State Secrets Act. But the judge said, in that case, said she doesn't even have enough information to evaluate whether that is correctly applied.
We're talking about Venezuelan migrants in this case. What precedent might this ruling have for others who the president wants to send to El Salvador?
Well, clearly the rule of law and the precedents around rule of law are going to be extended to other cases. In this Venezuelan deportees case, there are actually 2 that are filing the case, but there are nearly 200 in detention centers around the country that would be affected by this order, and potentially others.
All right, Bloomberg's Sara Forden, thank you so much for joining us as we deal with one piece of breaking news tonight, but we have to deal with another as well that we want to get back to. U.S. ratings downgrade from Moody's. For more, we turn back to the co-anchor of The Close, Romaine Bostick, who is joining us with an update on the market reaction. Romaine, obviously this dropped after hours on a Friday, so we have to consider the timing here, but what are you tracking?
And I just want to point out, I mean, I heard you had Joseph Lavorgna on a little bit earlier here. We should point out the first big downgrade that we got of that AAA rating. Of course, that was the S&P downgrade back in August of 2011. That was also on a Friday. It was also after the market had closed, so we had to wait a couple of days before we really saw exactly how investors would take it, and they did not take it well. When we came back in on that Monday morning, you had a Dow Jones Industrial Average plunge 6%, an S&P and NASDAQ that plunged about 7%, and the Russell 2000, which is small cap stocks and very economically sensitive, that plunged about 9%. You're looking at Treasury futures there on your screen, and this is kind of interesting because back in 2011, Treasury yields actually fell after that, and it was kind of counterintuitive, Kaylee, because effectively what happened was people took a sign when they saw that downgrade by S&P. They took that as a sign that there were broader economic issues, not just in the U.S., but globally, and that created a flight to safety. And where else do you run in times of trouble but, of course, to the world's largest and most liquid bond market? So that actually had kind of an opposite effect in the Treasury market, and that's what we're going to have to contend with when we come back to work on Monday morning, is exactly how investors are going to parse this. I also want to put it in context for you here, Kaylee. In 2023, when Fitch downgraded the U.S. from its AAA rating, It was kind of a shoulder shrug. Markets really didn't react to it. You had about a 1% drop the day after that happened, but all those losses were recouped in pretty short order. So it'll be interesting to see what happens here within the next 48 to 72 hours.
Yeah. Of course, we're in a bit of a different period of time here, Romaine. Of course, over the past couple of weeks, we've watched this remarkable round trip back to where we were before the inauguration, before certainly Liberation Day. And as we look at a market that's trying to right itself here for the year, you've already had some concern that we've run up too far, too fast without a great change in news, just indications of some trade deals for the most part here. Is this a period of time in which the market is at even more risk now when we reopen on Monday morning?
That seems to be what we're hearing from a lot of folks. The CIO over at Morgan Stanley Wealth, Lisa Shallett, was on Bloomberg Surveillance this morning and was saying just that. Basically, she was advising her clients to actually take profits specifically from the run-up that we saw in tech shares and actually move into things that were a little bit more defensive and things that might actually benefit from, say, deregulation and the like. A lot of people looked at this rally and they're saying to themselves right now that this other sort of leg of the stool, if you will, this holistic approach that the Trump administration has been trying to make with regards to trade policy, budget policies, and other fiscal policies, right now, this other leg of the stool certainly looks like it might actually give investors a little bit more trouble to wrap their heads around, particularly in light that Moody's has decided to basically weigh in before we even got an actual vote on this bill.
Another remarkable moment here with the help of Bloomberg's Romaine Bostick. We thank you for the analysis, Romaine. Up next, we'll have more reaction to the ratings downgrade as we are live with Congressman Tim Burchett of Tennessee. Much more ahead here on Balance of Power on Bloomberg TV and radio. Welcome back to Balance of Power on Bloomberg TV and radio alongside Kaylee Lines. I'm Joe Matthew in Washington, where tonight we're coming to you with breaking news after Moody's downgraded the U.S. credit rating, the agency delivering this hard line for U.S. legislators. Quote, while we recognize the U.S.'s significant economic and financial strengths, we believe these no longer fully counterbalance the decline in fiscal metrics, unquote, as it downgraded again, the U.S. to a AA1 rating from a AAA. For reaction to the downgrade and, of course, the backdrop of the budget battle taking place right now on Capitol Hill, Republican Congressman Tim Burchett of Tennessee joins us. Congressman, it's good to see you, as always, on Bloomberg TV and radio. Thanks for joining us here on this Friday evening. Moody's obviously sees these as directly connected, the downgrade today, with the debate that's taking place on Capitol Hill, the tax and spend bill that's supposed to lend itself to a reconciliation project here. There are great concerns about adding to the debt and deficit. Do you share those worries?
I do 100%. I come from Tennessee. We have zero debt. We're A triple plus. All the rating agencies give us that because we don't borrow money. We pay down everything, and we don't have a state income tax. And the federal government just prints more money. There's a lack of maturity in both parties, frankly, and people are just looking to get through the next election.
Well, so if you do agree, Congressman, do your colleagues Chip Roy, Ralph Norman, those who shot this big package down in the Budget Committee today, have a point that this bill, as written, as it stands right now, the various parts of it, should not pass?
Well, that's what Moody's has said, and everyone agrees with it. The problem is folks back home aren't grasping the seriousness of $36 trillion in debt and runaway inflation. In 7 years, the largest single item we'll pay will just be interest on our loan. And the Chinese are going to stop playing ball with us, and we're going to collapse if we're not careful. I tweeted today, I said, I'm worried about losing our majority, but I'm worried more about losing our dadgum country, because what we know today, the economic freedoms we enjoy, will not be enjoyed much longer if we continue down this path.
Well, of course, President Trump would say that then if we don't pass this bill, it'll result in the biggest tax hike in recent history, 65% higher for some folks. What's worse for the fiscal health of our country, a tax hike or more deficit spending?
I think we can actually get by positive on both. We can reduce spending and keep reducing taxes. All we're doing is continuing the tax credits that President Trump had put in his first term, and it's not going to increase on anyone. And so if we would just do some fiscal responsible programs and stop playing around and stop worrying about elections, I think we could all get there, but we're not. Everyone will be, more people in Washington, rather, they're worried about being in leadership or worried about being in majority. They're not worried about putting America first. And Trump actually is. I believe he's going to get engaged. I believe that there is going to be some things resolved. I believe Chip Roy and my dear friend Congressman Norman understand that as much as anybody does. And they're worried more about our country's fiscal responsibility, as I am, than our own political futures. And I believe President Trump believes that as well. And I think that's why they'll come together. I tell folks, look, this is like an NBA basketball game. Don't watch the whole game. Just watch the last 2 minutes and we'll get it worked out.
Well, so does this mean, as we consider President Trump, who you think shares some of these beliefs, that he is asking for too much that would add to this burden? Congressman, should he not be getting everything he wants when it comes to no tax on tips or overtime, for example?
And do you honestly think people are paying the full tax on tips now, ma'am? No, I believe that President Trump wants fiscal responsibility. He's a businessman. He understands just because he has money doesn't mean he should spend it. And if he doesn't have it, he knows dadgum good and well he can't spend it. And I believe our side of the aisle, the conservatives, is myself, because I haven't checked off on this plan yet either myself, and they know it. But they're the ones that'll be voting on it in the committee. So, yeah, I think there's room for both. I think we can reduce taxes. Why don't we just reduce the size of government? If we could just go back to under pre-COVID spending levels, ma'am, we could work this out. You can't name me one program that's been, and I'm not pointing you out, but I'm saying America can't name one dadgum program that's been added since COVID that you can't live without. But yet, if we went back under that, we could balance and work this thing out. But we don't have the maturity to do that. We are addicted to our grandchildren's money, and that has got to change, both parties.
Huh. Well, with that said, what's your message to Republicans, many of them from the Northeast, who are looking for a higher SALT cap, Congressman? Can you afford it?
No, I don't think it's fiscally responsible. I think we can probably afford something. It's state and local taxes. All they're asking, New York, New Jersey, California, these Democrat-controlled states, all they're asking the Republican-controlled states that are acting responsible is to supplant their lack of tax dollars. They're going to put another radical program in that costs them money. They're going to tax businesses, drive businesses off, and they're going to ask the responsible Republican-controlled states to bail them out. And that's all the SALT tax does. They should be forced to fix their own dadgum problem within their states and keep their hands off of Tennessee's money. But I suspect there'll be a compromise. We used to say in the Tennessee legislature, everybody's going to be a little unhappy, but at the end, it's going to be okay. And look, we get 95% of what you want. I'd call that a victory. And I think we're on that right path. I think President Trump is engaged with this. And as he usually does, he waits to the end. He sees what everybody wants, and then he tries to figure something out. That is the art of the deal, and that's why he's successful.
It does raise the question, though, Congressman, finally, of timing, knowing that the Treasury has warned Congress needs to pass a debt ceiling increase by mid-July, or we risk running up against the X date, which could create a whole host of potential problems with the rating agencies beyond what they're already warning about. Does that potentially, this ratings downgrade, though, add fuel to those who don't want to see the debt limit increase by much in the name of fiscal responsibility? What does that do to this entire argument?
It makes it an argument that we need to be more fiscally responsible, which I doubt we, in the long run, we won't. See, a lot of these plans, these tax plans that we had in place were 5, 6 years, some were even almost 10 years down the road before they would be implemented, and that's how they were balancing the budget. And you know good and well that Donald Trump is not going to be the president in 5 or 10 years. And possibly, unfortunately, we might have a Democrat in there, and they're going to do away with everything that we've tried to put in. That's why it's important to make these things permanent and quit with all the double talk. Ma'am, we just cannot spend more money than we take in. That's the bottom line. If we could just get back to some fiscal responsibility, we could do that. And the bonding agencies and all the rating agencies would love that. America would sure love it, because their dollars would go farther and they could be able to save up for that American dream.
Congressman, bring us behind the scenes for a moment. What are you hearing from your colleagues about this budget committee hearing that's set for Sunday night? Will this actually pass? Can we get to rules next week?
I think if we get some agreement, like I said, hold your nose on the SALT thing and get the Medicaid stuff worked out, the waste, abuse, and fraud, and quit listening to I'm glad you all haven't joined in this, but when you're cutting waste, abuse, and fraud and things like Medicaid, that just provides more money for the least amongst us. They ought to be for that, but in fact, they're not, because it pays for all their bogus programs on the left, and they know it, and it pays all those people to come to the polls that aren't going to work. And America's sick of it. Look, if you've got kids or if you're disabled, and you can't work, the program's for you. But if you're not, if you're able-bodied and sitting on the couch and watching and watching The View all day, that gum, you ought to be out getting a job, and you at least ought to qualify for some for some job training. That's all we're trying to do with this. We're taking the illegals off of this stuff. We can do that, and then agree to hold our nose on something on salt. I think we can get to that table.
We'll see what The View has to say about that. Congressman, thank you. We'll keep talking about this, I hope. Tim Burchett of Tennessee with us live on Bloomberg. Thank you for the insights. We'll have a lot more coming up as we play all this to our political panel next on Balance of Power on Bloomberg TV and radio.
Well, the noes have it. The committee stands in recess, subject to the call of the chair. I want to thank everybody for their time and patience, and Godspeed and safe travels.
That was Congressman Jody Arrington, chair of the House Budget Committee, seemingly defeated earlier today after his committee failed to move the Republican tax bill forward. Fast forward to this evening and a downgrade from Moody's, and this bill might be in even more trouble than it already was. And joining us now for more reaction to this here on Bloomberg TV and radio is this evening's political panel. Republican strategist Maura Gillespie, founder of BlueStack Strategies, alongside Democratic strategist Jim Kessler, executive vice president for policy at Third Way. Welcome to you both. Maura, of course, you've spent plenty of time in the House, including working for a speaker. I can't imagine that Mike Johnson is feeling very good about what Moody's is saying here, as it specifically talks about fiscal policy proposals under consideration. Did he just lose any chance of being able to negotiate his way to this bill passing this weekend?
It certainly made things a lot harder for Speaker Johnson. You know, I'll remember when Speaker Boehner was working with then former President Obama, trying to hash out some of these budget conversations that are certainly going to keep coming up over the course of these next few days, next weeks, next months. But to think about where the debt is now to where it was even during the Boehner days, it's more than doubled. And Moody's putting this out there certainly does not help Speaker Johnson or the Budget Committee on Sunday as they try to move this bill forward. And I do think that it just adds fuel to the fire for those strongholds who felt very, passionately about not enough cuts being made. And so this is only going to bolster their position, I think, in keeping them from fully supporting it as it currently is written.
Wow. Jim, did the earth just shift under Speaker Mike Johnson's feet?
Yeah, it just did. I mean, this bill was in trouble. Now it's in really serious trouble. The Moody's downgrade, the credit downgrade, it just gives huge impetus to the hardliners, the Freedom Caucus, that really want a dramatically more brutal, harsh bill. It hurts the Salt Caucus folks that want bigger deductions for salt. Will they get to something in the end? Of course you have to, but this bill is going to have to radically change. The radicals on the right just got a big win.
Wow.
Well, those radicals on the right, though, at least some of them, have a history of changing their votes when the president calls. Do you think that will be the case this time, Jim?
I also think that since April 2nd, Liberation Day, and April 9th, the withdrawal of Liberation Day, we've seen a very diminished president where people are much more willing, both abroad and at home in his GOP caucus, to stand up to the president. And I just don't think he has the power that he did 6 weeks ago.
Wow. Maura, what are the speaker's options right now? As a veteran of another Republican speaker's office, what are the menu of options for Mike Johnson? There are still 11 spending bills out there, right? They could be combined in many different forms over the course of the next couple of weeks.
Absolutely. And one of the things that has not really been explored, at least to my knowledge, in this speakership, is the fact that we know that the bill is going to change no matter what happens, right? It goes to the Senate side, and the Senate has already, many of the members there have talked about that this bill, as it was currently drafted, is dead on arrival when it comes to the Senate. So perhaps then Mike Johnson wants to go ahead and reach out to John Thune and say, what are some of those changes that are going to be made? Because if you're going to ask the president to come in and strong-arm those members to pass his agenda, because that's what this bill is. This one big, beautiful bill is Trump's agenda. This is what the president wants, it's in there. And so Speaker Johnson may want to go and talk to Thune and say, how do we get this across the finish line for the president? What are some things that we need to be doing? And I think until this point, maybe those conversations haven't happened because the House really felt strongly about taking this on their own. But now I do think it's time that they make those outreach efforts. I also think, with the president's talking about different things that are going to be so costly, again, with the Alcatraz, maybe that's not the best idea of spending millions to create Alcatraz. Maybe you don't accept a foreign gift of a plane that's going to have to be taken apart piece by piece and then reconstructed, costing another millions and millions of dollars. So there are some conversations that need to be had in the Republican flank to streamline the messaging on cost savings, not cost adds.
Well, I have been checking Twitter since this downgrade hit, waiting for those Republicans who shot down this bill in the Budget Committee today to chime in to make the point that Moody's is helping them make their argument. And the first one just hit from Congressman Ralph Norman, saying on X, Moody's just stripped America of its last AAA credit rating. This is Exhibit A for why we need budget hawks in Congress, runaway deficits, reckless spending, and no serious plan to fix it. Stay tuned to see if Chip Roy and others follow this one. But to the point that Maura was just making about how this could change in the Senate, where you have obviously vast experience, Jim, does this actually, though, make it less likely that the Senate is going to try to roll back dramatically cuts to Medicaid or the rollback of subsidies in the Inflation Reduction Act because they need to make sure the price tag is not too high? Does Moody's also make this harder for the Senate?
Well, here's the question. Do you want to give an $80,000 tax break to blue state families through SALT deduction so that you can hurt red state working class people by taking away their Medicaid? So this just makes the situation that much harder. And look, I've seen this happen before. This happened in 1993 with Bill Clinton when he radically changed the reconciliation bill because the bond traders out there were saying, we've got a problem here. You need a very, very different bill.
So what change do you make? Can we be specific? Is there anything that Speaker Johnson could change that would be palatable to this conference?
Well,
you're going to upset one end or the other.
I'm going to take one of Donald Trump's ideas and say they should do it. People with incomes over $400,000, $500,000 should not continue to get the tax break that they
millionaires
got.
Tax.
The millionaires tax, and probably down to $400,000. Like, it is ridiculous that we're doing this right now. And look, I disagree with a lot of the Republicans on how you need to get this budget closer to order. But like, we have a massive mismatch between revenue and spending here. And frankly, I think more of the problem's on the revenue side, but some of it is on the spending side. And we've got to raise more revenue. And yeah, we've got to do something on spending.
Well, does raising more revenue, Maura, perhaps put shine a more positive light on the president's current tariff policy that he's arguing is bringing more money into U.S. coffers? I just wonder how you view the other kind of pursuits of this administration factoring into this whole equation, in addition to what they want on tax policy.
If I were in the Trump White House, I would certainly tout that and point out how they are trying to bring in more revenue for the United States and for American companies and for our GDP, and looking at those tariff policies and talking about how they try to make things more fair and making sure that America is not at a disadvantage when it comes to our trading partners. Again, I have said several times about how to go about that from the get-go. I do think that there was a diplomacy element that was severely lacking, but at this current stage, it's an opportunity to leverage those that have already been secured, but it could also call into jeopardy some of the ones that are outstanding because of America, this decision, and also the budget deal kind of faltering here. They may be at a less strong position to negotiate with our allies and trading partners. So again, from a messaging perspective, I would certainly bring this up if I were the Trump team, but also as those economic advisors, they need to be thinking through, okay, what is plan B, C, and D?
Jim, we just heard from your former boss, a statement from Chuck Schumer. Moody's downgrade of the U.S. credit rating should be a wake-up call, he says, to Trump and congressional Republicans to end their reckless pursuit of their deficit-busting tax giveaway. Now, all of a sudden, Chuck Schumer has Moody's behind him. Does he engage right now with Speaker Johnson or pop the corn and watch?
I think they're going to pop the corn and watch. I mean, a reconciliation bill is there for a reason. It's there so that you don't need Democrats in this situation. But, look, you're watching the president. He has retreated on tariffs. He's retreated with Ukraine. we're seeing you could see some retreating right here, too. Like, this is the place where he is scaling back. And I think that's a good thing, frankly. But this is a wake-up call. And you're not going to get it on time. You're not going to get it by taxing people going to Walmart. Like, that's not how we're going to make up this deficit.
Great conversation with Jim Kessler and Maura Gillespie. Thank you both so much for a great panel on a breaking news evening here in Washington.
And of course, it's going to be a working weekend in Washington as well as the Republicans try to get their heads together on the budget reconciliation package. This Moody's downgrade making that all the more complicated. And we'll have fresh coverage for you on Monday here on Balance of Power on Bloomberg TV and radio.